Hank Smith, CIO of Haverford Trust Company. You manage about $6.5 billion. Good to have you on today.
Nice to be with you, Adam.
You have commented that stocks are the new bonds.
That is correct.
What do you mean?
Well, look, in a yield-deprived market where you're getting no return with fixed income, look toward high-quality blue chips where their dividend yields are greater than that of their own 10-year debt, let alone much greater than the 10-year Treasury. So if investors are willing to assume some volatility and are investing for income, look to these great blue chip companies, and as an add bonus, you're going to get dividend increases each year on top of that.
All right. Well, joining us, as you know, Hank Smith, Chief Investment Officer at Haverford Trust. Hank, we started to talk for a moment about stocks being the new bonds. You have the 30-year. Well, the 10-year trading at what? 206. There it is,
right.
2.06%. And yet there's so many stocks out there that yield well more than that. So what is going on, and what are you buying?
Well, look, it has been since the mid-50s since you've had this many stocks yield more than fixed income. So I think it's reflective of really the fear and pessimism that is prevalent today. We are focusing really on a barbelled portfolio, to steal a fixed income term. On the one side, your steady Eddie defensive companies in consumer staples and healthcare, the Johnson & Johnsons, the McDonald's, the Walmarts of the world. And on the other side, the more offensive, cyclically exposed companies in industrials and basic materials, like a DuPont, a United Technologies, a Caterpillar, as an example.
Hank, I'm just curious, actually, how frustrating is it right now to be in the market and to see that all U.S. stocks, regardless of the dividend they pay, regardless of the fundamentals, are trading as one, right? It's one basket. Sell U.S. stocks, buy U.S. stocks. Right. Is that frustrating, or does that provide opportunity? It's
very frustrating, and it's helping create this negative sentiment that is out there. Since when did oil correlate with stocks? It makes absolutely no sense.
About 6 months ago, right? And all of a sudden, they've been locked at the hip.
That's right. But when we see down days like this, we see dividend yields go higher, and it, to us, is an attractive entry point to take advantage with these good yields.
How patient, though, do investors have to be? Because, I mean, people have to be willing to stomach some pretty down months, arguably, maybe even down quarters.
Well, if you look at stocks as though it was fixed income, when you buy a 10-year bond, almost by definition, you have the patience for 10 years. So if you're looking at stocks for the yield, then don't get worried about the fluctuation in the price. You've got that yield. You're going to get dividend increases, and we believe over 3 to 5 years you're going to be well rewarded.
All right, so if you just look at that group that we've got up there, McDonald's, DuPont, Johnny John, Conoco, right, et cetera, let's say the average dividend yield in that group is about 4%.
Right.
So if you hold it for 5 years, that's 20%. But in this kind of market, you can get a 20% downdraft in 2 weeks. So you're waiting a long time to make it back.
Well, that's right. But you take something like McDonald's. If they continue at a 3.1% dividend yield, if they continue increasing their dividend at 10%, in 10 years, if the stock's done nothing, you have an 8.5% dividend yield, and you have done so much better than you would have having bought the 2.6% 10-year McDonald's bond.
And to your point, McDonald's is up 25%. I guess that one's working pretty well.
That one's working very well.
And what about growth versus value? Are you buying any growth stocks, or are you more from the value side?
Well, we're managing both a quality growth portfolio and a dividend yield portfolio. We think there's just tremendous opportunity, though, in that dividend yield strategy with the higher yields that the market's giving you.
Hank, we want to bring in some comments that we had earlier on Bloomberg Television. Mohammed Al-Arian joined us, and in fact, this is his advice. Ones that he's giving to investors.
We are in such a fluid world right now where the left and right tails are so large that I don't think you can be symmetrically positioned towards either risk, because one of them is very difficult to recover from. So that's why general defense makes sense in this incredibly volatile, headline-driven market.
So in what way, that was Mohammed Al-Arian's thoughts, obviously, on positioning for such volatility, and that obviously fits clearly into your strategy as well.
Oh, absolutely. Defensive, though, is in high-quality stocks where you don't have balance sheet risk, where you have a high degree of predictability of earnings growth, dividend growth. And so then all you need is patience and the willingness to put up with volatility. I know that's a lot to ask for, but that's the opportunity today.
We had that melt up in October. It stopped dead. Does this thing resume?
Well, look, if we can really get a credible outcome in Europe as a headwind being removed, you could continue to see a further melt up, particularly if we get some good news out of the group of 12. So those are your two near-term headwinds, and with some positive resolution there, a continued melt up.
All right, Hank Smith, CIO of Haverford Trust Company. You run $6.5 billion, and you like those dividend stocks. Thanks for joining us.